Okay. We got caps for the agencies. FHFA's announcing we got some of those caps. They're going up in a big way for Fannie Mae and Freddie Mac. Out of Washington, D.C., this came out on November 24th. U.S. Federal Housing announced today that the 2026 multifamily loan purchase caps for Fannie and Freddie, the enterprises, will be $88 billion each for a combined total of $176 billion to support the multifamily market. This is good news because we need the lending capacity. It looks like this year we may be running right into the caps. So this increase is very healthy. And I can tell you just anecdotally, talking to a lot of lenders very recently, Fannie and Freddie, they're running into these caps. The FHFA basically limits them of you can't do any more conventional lending than what we're allotting you. Mm-hmm. And so when they get close to those caps, what they do is they just increase their pricing. And so their spreads will start blowing out. They're just not competitive on terms. And this is in a time period where we're supposed to be supporting housing. Mm-hmm. We're not trying to crash the economy by letting too many deals fail. But the agencies, they support housing by providing adequate liquidity to the market. They've been tightening things up recently because they're running into these caps. So hopefully we are going – not hopefully. The caps for 2026 are going to be up at again $176 billion between Fannie and Freddie, and that's a good thing. But man, these agencies, Fannie and Freddie, they need to be completely restructured. I mean, they don't deserve to exist in their current form, maybe with the current people that are there. Again, I have do hundreds of millions of dollars with Fannie Mae and Freddie Mac of business because they've got this government guarantee, which makes their debt cheaper. They have essentially government mandated duopoly. I mean, they were basically created around the Great Depression to facilitate the securitization of home mortgages. And, Fannie Mae became this, big monopoly. And they created Freddie Mac because they're like, well, you need a little bit of competition, Fannie Mae. So they created Freddie Mac. And, they're most in the business of securitizing mortgages. And, they do multifamily loans, and they make up about 50% of all multifamily loan originations. But it's a revolving door. The people that work there for, months, maybe a couple of years, and they move on to whatever, private sector gig. There's a lot of great people, I'm sure, working. Fannie Mae, Freddie Mac. A lot of good people. It's just the way that they're being run today is really inefficient. And I don't know if they really... Should we have a government guarantee that basically that backs these mortgages, that allows for a lower interest rate because it's more secure? You got the government's going to step in and say these loans aren't going to go bad. Does it help support housing? Yeah, on the margins. It also drives housing up, the cost of housing up, because all of a sudden I get better leverage. If I get more loan proceeds, if I get a lower interest rate, that allows me to spend more money on those apartments. I can pencil paying a higher price and get the same return. And multifamily is already nothing's without risk, but a relatively lower risk investment compared to, call it office, call it hospitality. There's tons of interest. If you removed the government guarantees, you'd still do plenty of business. There'd be plenty of support for housing. And I'm not necessarily arguing that the guarantees go away. Absolutely. I'm more just saying that I don't know if we need Fannie Mae and Freddie Mac in the form that they're in. So, there's obviously a lot of talk about an IPO, privatization, all that. We'll see what happens. But again, we're in a period of where we have a housing crisis going on. Apparently, the federal, again, this is how maybe disingenuous the government is about fixing the housing crisis. We're talking about we're going to declare this housing crisis. We're talking about we talk about the 50-year mortgage and all this other BS. But it's well, the agencies are actually responsible for doing all the lending. They're not even playing ball. They're giving us tier 3 pricing on deals that should not have tier 3 pricing.
Right. We talked about how that's squashing deals.
It's squashing deals. Maybe is it on the margins? maybe, but man, anecdotally, I've heard of multiple deals that have essentially been killed because it's like the agencies didn't really, not just they weren't playing ball, they just like didn't care. Because they're near their caps, these artificial caps.
Yeah, you start underwriting, certain pricing and expectations, and then all of a sudden they come back to you and they've tightened up their procedures, and now you're looking at pricing that no longer becomes appetizing to your deal, or definitely reduces the overall interest that maybe you have from your equity partners.
Well, in your, I don't know if we've talked about these exit tests, refinance tests, but it's like you're shooting in the dark. You don't even know what the target looks like. But they're saying you have to hit it. It's very clear when the requirements are the loan has to have a debt service coverage ratio of X, 125, 130, 120, whatever it might be. HUD could be down even as low as 115, 117.
Some of the upfront criteria way more recognizable, understandable, identifiable.
Yeah.
But on the back end, that exit test, you don't even know what they're trying to solve for.
Comment below if you know what we're talking about. Comment below if you know. They changed the exit test. They don't tell you what. There's a model, and I've heard fables about this model and how long it takes to run through and check things off. We don't know what it's solving for, but the goal is to determine how risky is this mortgage? Will we be able to repay the loan at the end of the day? Then we don't know what the assumptions that they're using. And whether you can pass that exit test determines what your final loan will look like in terms of your loan proceeds, maybe even your spread, years of interest only, primarily loan proceeds. So you don't really know. And they also don't necessarily, they'll do it up front, but then they also do it, nearing close before they give you that final commitment. And if you don't pass the exit test or it's close, they'll shave off your loan proceeds without telling you necessarily why.
And as you approach close, we're talking 14 days, 21 days.
So we're not just like making this story up. This is what happened on our last deal, Flats at Stones Crossing.
Yeah,
is we're getting ready to close less than 14 days. We were actually penciled to close within I think 5 business days.
Yeah.
And 5 business days, and they make a long story short. We get a word that like, hey, we're not fully passing the exit test. I'm like, what do you mean? Our DSCR is so high. We've got all this cash flow. It's. Well, they're like, well, we don't know any of the details of the actual exit test. However, they told us some of the assumptions. We don't know their model, but they used. So we bought a newer property, right? It's a 2024 construction. Just completed a lease up, but it was fully occupied. They were already burning off concessions, no longer even offering concessions at the property, highly occupied. But they said, well, a year ago you were offering concessions. Yeah, that wasn't even us. It was the property manager that was leasing the property out for the developer. And they were like, well, 6 months ago you were offering concessions, 3% concessions. So we're going to assume you're going to continue to have 3% concessions throughout your entire hold period. Like, we're not going to operate the property like it's a lease-up property throughout the entire hold period. No flexibility, no wiggle room. But we're going to reduce your loan proceeds by $2 million.
$2 million. It came down to
5 business days before it closed. Hey, guys, we need you to bring another $2 million to the table.
Yeah.
This is a stabilized, super clean deal in an incredible submarket. Just solid deal. Like, so solid. And you've got these nice guys in Washington, D.C., and gals and people in Washington, D.C. that have some model that we have all we know is that they're using 3% concessions aren't helping us. So again, am I a little bit bitter to the agencies because of that? It doesn't help, but there's been a lot of other instances of where, man, these institutions that are basically have this duopoly on lending in our industry are not the quality institutions that we'd like them to be. And there should be some competition, but there can be no real competition if they've got this government guarantee and nobody else has the government guarantee. So
the only solution on that instance you mentioned is to go find $2 million in equity. You can't go put a secondary note on there because now you got to go back to the already committed capital. Yeah. Refresh them that now there's.
Well, the lender won't even allow you to do it.
Correct. Yeah. So the only way that deal gets across the finish line is in the next 5 days is $2 million in common equity.
fortunately, we've got a great team. Griffin and Blake were able to scratch that $2 million together. But
We did.
fortunately, Great Capital, we have the capacity and the equity partners to be able to do that. That's why people award us deals. Because Great Capital always is able to raise money, always closes on deals. But that's how you kill the deals, guys.